Hi everyone, it's Alex here at Cestrin Capital Research. Welcome to our live webinar. It's currently Wednesday, the 24th of May. It's 4 p.m. Eastern. Very special session today. I want to introduce Jake Wojtasek. Jake was a founder member of TrendSpider, the charting and trading software business. Prior to TrendSpider, he's been a lifelong technical trader and recently moved on from TrendSpider to set up on his own running Jake Wu Market Research. That's a unassuming name, but it's a great service that Jake runs on Twitter. He produces plenty of free content, but also runs a subscription service on Twitter, part of the new subscription function on Twitter. It's just $10 a month and does fantastic work. We at Cestrin are paying subscribers ourselves, love the service and love Jake's work and learn a lot from him. He's here today to talk to us about how to use charts to remove your trading biases. As we all know, we are our own worst enemies when it comes to trading. Our own emotions, fears, greed, worries, overanalysis, you name it. And if you can use stock charts correctly, you can eliminate much of that. And you can define and bound your error bars and improve your success rate. And Jake will be telling us all about how to do that. Before we go on, I should have a disclaimer to read to everyone. It's going to be on your screen right now. I'm just going to read that and then we'll get through to the heart of the matter. Okay, so disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission, and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrin Capital Research. Cestrin Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so with that, I'm going to hand over to Jake, who is going to present to us in just 1 second.
Can you see my screen, or do I need to reshare the chart? Oh, there we go.
Should be able to see it right now. Yeah, we can see it now, Jake. It's all yours.
Awesome. Well, thank you for having me on. Again, thank you for being a customer of the new subscription and Jake Wu Market Research. So, to give a little background, so I started in the markets when I was about 12 years old. Not out of my own personal interest. My dad actually one day just said, "Hey, I want you to learn about the stock market. I'm going to put some money into a custodial account, and I'll give you $1,000 to buy some stocks that you think are interesting." And pretty much from yeah. Well, it's funny because he hates the stock market, so still wondering how that whole thing started. But I am very, very thankful that he did put me into that position and where I could learn very early on. And the way for those that have kids and young kids especially, the way I like to look at starting in the market young is like learning a language. The market has a lot of terminology, a lot of things that really are essentially another language. And so the earlier that you can get familiar with that language, and even almost a visual language too, with charts and that type of thing, the better off you are. And I'm very lucky to have had the opportunity to have my dad kind of put me in that position where I was able to learn pretty early on. One thing that I found almost immediately when I did start dabbling in the markets was I was looking at charts pretty often. Not even realizing really what I was looking at. Pretty much up until about 17 or 18, I really mainly used line charts. So before I even really knew it, I was following trend without knowing I was following trend. I was looking for basic things, higher highs, higher lows, without even really knowing what I was looking for. I just knew, okay, this is what the chart looked like the last time that I had a good setup and a good trade. So for me, charting is a way to essentially have a roadmap of price, and not only just for investing. If you're investing, sure, you can look at the fundamentals, but you still have to know where price is and what the chart looks like. And so having a roadmap, not only on the longer term time frame, but if you're a shorter term time frame trader, maybe a day trader, maybe a swing trader, charts can really help you in the sense of really just looking at probabilities, right? And that at first is a great way to take emotion out, because I have a lot of the time people will ask me on my Twitter, is that setup, is that setup a bullish or a bearish setup, or what is this? Does that mean the stock is going to go up or down? For example, if you're looking at an ascending wedge or you're looking at a falling wedge, all of these types of setups have probabilities, and it's no different than if you went to go play blackjack at a blackjack table. It's almost like playing by the book, right? If you have this and the dealer has that, you do this. If the dealer has this and you have that, you have a probability of X of winning, or you have a probability of X of losing if you do this or that. And so being able to keep not only your analysis systematic, but also just the way you look at the markets in general is a great way to remove emotion. Same thing in poker, right? If you're playing poker, I personally am not a huge poker player. I used to play when I was younger and I wasn't great at it. I most of the time just couldn't sit at a table longer than an hour without being like, okay, I'm ready to do something else. And poker is the same way. If you're playing poker, and I have a lot of friends that play poker, and I know how they use statistics in their poker playing. When you have a hand and you are essentially going against somebody, you're gambling and you're betting that you're going to beat the other hand. Let's say you're playing Texas Hold'em. You are not really thinking about what is the hand that I'm holding. Sure, that's important to know. What's the statistical probability of, this hand that I'm holding? What's the probability that somebody else may not be holding something similar? But you also want to know, what is the other person that's betting against me? What are they holding, and why are they betting? Why essentially are they raising the bet? Why did they just go all in? Which is never a good idea in the markets, but obviously in poker for sure, people will go all in. Whether that is to use that as a way to bluff or because they think they have that strong of a hand, but they are making these decisions not just based on what they have. They're also thinking, what does the other person have? So, in the market, one of the biggest things to help you remove emotion is simply knowing what is the other side of the scenario or the perspective. What perspective do they have? If I'm going long on the S&P 500 and somebody is shorting it right at the same time, which is essentially what creates liquidity in the market, what are they seeing that I'm not seeing? And so being able to see both the bull side and the bear side is something that's really, really important, and charting can really help you do that. So that is something that you always really want to be able to visualize, because when you only are looking at one side of the market, it's so easy to create a bias, because then every chart that you're looking at, if you have, let's say that you're oversized in a position that's long on the market. Let's say that, and if you guys can see my screen, let's say that you went long on the market, right around here. There was a gap above, price gap above that filled at 421.22, way back from the August highs. And so, what was somebody else seeing if I went long here, but somebody was going short here? Well, the person that was going short probably thought, okay, well, gap fills or gaps in general, a lot of the time can be resistance. Okay. And that's what happened. This gap was perfect resistance. We didn't fill it all the way. We filled it partially, had a pretty ugly candle here, and then we started to reverse. So the person who was shorting the market definitely probably saw the gap being a resistance zone. I'm studying for my CMT, Chartered Market Technician exam. I have my third one in December, and one of the biggest things that they talk about, or at least in pretty detailed educational things, is literally simply gaps act as targets for price, but they also act as resistance and support zones. So if you're moving to the upside and you have a gap, you always want to at least have a base case scenario that this gap is likely going to be short-term resistance. Same thing on the downside. If you're moving to the downside, let's say going into tomorrow, we continue down, you have a gap right here. And that would be, if we continue down, which we closed almost right at the point of control. The point of control is just part of the volume profile, which shows you where is the most volume, essentially, where has that been traded since X period of time. If we did start moving down tomorrow, this would be a target. One, because prices like to gravitate towards inefficiencies in the chart, i.e. gaps in price. And two, they act as support. So not only would this maybe be my target on the downside, but this would also be my target for a potential support zone. So, going into a trade, knowing this is why somebody is betting against me, can really help open your eyes to accepting that you're going to be wrong. Some of the best traders in the world at the most have like a 60% win rate, and that's even extremely high. What most traders are really good at is they're good at taking losses quickly and letting their winners run. And on top of that, being able to understand why is the trade going against me. And that goes into what I'll be talking about here shortly, is invalidation levels. Before I go into that, I did want to go back to what I mentioned regarding the setups in the market, right? A lot of people will ask me, okay, so that's an ascending wedge, that's bearish, right? Or that's a falling wedge, that's bullish, right? And the answer is no. There's always a statistical probability that yes, an ascending wedge is statistically bearish, meaning that over 50% of the time, based on research that many technicians have done in the past, ascending wedges are looked at more of a bearish setup, but you have to wait for price to confirm that. Same thing here. Let me pull up Solana. This is an example of a falling wedge that let's see which one, Sol USD, that was forming a falling wedge the other day or yesterday. And of course, I need to find which exchange I did this on. I think it may have been Coinbase. There we go. So this is a great example of pretty much what is typically considered a bullish setup. A falling wedge, a lot of the time, statistically speaking, does break to the upside versus the downside. However, you can see here that we're breaking down, and that this particular setup is pretty much invalidated now. And the reason why it's invalidated is because we're breaking down below this previous low from the falling wedge that was forming, and the bull thesis is invalidated. And it's that simple. Yes, statistically speaking, this had a higher probability of breaking to the upside, but a very simple invalidation level would have been a break of the bottom of this support zone and a daily close below it. So it really depends on your time frame, right? If you're swing trading and you're using a daily candle, you really want to have your invalidations on the daily candle. Obviously, it's kind of hard to have an invalidation of a daily close until the daily candle closes. However, going into the last 15 minutes of the trading day, a lot of the time you have a pretty good idea of where price is relative to the invalidation level. And so you do need to wait for the actual daily close to occur, but you can start to be proactive into the last, let's say 10 minutes of the day to get an idea of, all right, we're 1% below this invalidation point. There's a pretty high chance that we're going to invalidate here without me having to actually wait for the daily close. So I think it really depends on what type of trader you are. And this is something that I've dealt with in the past, and even partially dealing with now for people who are day traders looking at a daily chart. One thing that you need to do, especially to remove your bias, is know what time frame you're trading on. If you're day trading and you have a contract that expires in 2 days, and you're just making a quick day trade, you probably shouldn't be on the daily candle and have your invalidation on the daily candle. You probably should be on the 5-minute candle to have your invalidations and your confirmations and your targets. And so, oh, sorry.
No, go ahead.
I thought you said something.
No, it's okay.
You know, knowing what time frame you're trading on is really important, because if you're swing trading and you see, okay, there's a slight intraday breakdown, but my invalidation is based on the daily close, then you probably shouldn't get too worked up about a slight intraday breakdown if you're waiting on the daily close. It's definitely worth noting, but if you're swing trading something on the daily chart, that is going to be a completely different view and a different strategy than if you're trading something on a 5 or a 10-minute candle. And so knowing, okay, I'm day trading, I probably shouldn't even be on the daily candle. I should be on a different time frame, will really help you create a roadmap that's appropriate for your trade. As I mentioned, if you're trading something that expires in 2 days, being on the daily candle is probably not going to do much for you except hurt you, because there's such a discrepancy between what's going on the daily chart versus what's going on in the 5-minute chart. Candles are fractal. Setups are the same on different time frames, but you still have to know what time frame you're trading and what time frame you're really having your invalidation on. And that's something that a lot of people make a mistake on is okay, well, I'm day trading, but I'm using the wrong time frame. And just changing things like that, just saying, oh, maybe I was looking at the wrong time frame, can completely change how you look at the chart, remove your emotion, because okay, I have time to be wrong, or I have time to be right. When you're day trading, you've got about 10 to 15 minutes to be wrong or right. With a swing trade, you may have a few days to be wrong or right. So being able to nail down what type of trader am I and what time frame do I want to trade on will really help charts become a big part of where your invalidations are. And so my point is you really want to find something that you have success with. And one of the main things that I see people do, and this is honestly why I personally don't use scanners a lot, is because scanners are great if you have a basket of, let's say, 10 stocks that you kind of keep an eye on every day. But if you're doing a scanner and you're scanning 1,000 stocks and you find a stock that you've never even heard of before, you don't know how it trades, you don't know what's the spread, what's the average daily volume, you're really kind of going into a trade a little blind. So being able to really understand the personality of a stock and get to know, quote unquote, get to know the stock or get to know the asset that you're trading, really will also help you remove that emotion, because you can say, all right, Tesla did this 2 weeks ago. I know exactly how this works. And a lot of people do trade the same stocks. So that's why stocks do have, quote unquote, their own personality, because there's different types of market participants trading different types of stocks. You have different types of liquidity within different stocks, which creates, that whole different side of the equation. And so being able to, let's say, pick out a setup and then pick out a stock that says, okay, every time I have a falling wedge on Tesla, I've been trading this for a year, I know that Tesla reacts pretty well to a falling wedge setup, versus maybe something like Solana has been breaking down through falling wedge setups over the last 6 months. So really getting to know the stock, getting to understand the chart, getting to understand, okay, how many times does this give a false signal where you've got a big intraday breakdown, but the daily price closes back up above the VWAP or whatever I'm using? That is really, really important.
So Jacob, let's pick up on 2 points you made so far. First of all, you said at the start, which had me smiling because I used the same term. Charts are the language of the securities market. For anyone who's done any form of liberal arts education, you learn in college that language is a form of semiotics, science. And when you're a kid and someone's teaching this, you think this is garbage and you don't really know what it means and the rest of it. But then you grow up, and the same is true of stock charts. It is absolutely a language that's spoken. It is the language through which price is communicated, volume is communicated, all these things. And it's a sort of language that a machine can speak, which of course is why algorithmic trading is a thing. And so I can't emphasize strongly enough that when people start technical trading, it looks like a bewildering amount of information, random walks, imagined patterns, traders just seeing whatever they want to see, but it's not. Setups are languages, they're phrases, paraphrases, conversation setups. And once you conceptualize it that way, and you think you are learning to speak a foreign language, it's a really good metaphor for getting good at technical trading. The other point I'd want to emphasize is scanners. I don't use them ever. People, I think, have a tendency to trade too many securities, right? There is usually, unless you're a sort of Alan Turing level genius, chasing around too many variables is a great way to lose money, I think, because you can't follow that many things. It's best to follow them manually rather than having just a machine follow them. And you need to understand that the language and, as you say, the personality of each security that you trade. And it's absolutely true that in addition to standard, market setups like some of the patterns you described, we use Elliott waves and Fibonacci's and all that, and they're standard across securities. But specific stocks and securities do have their own repeating patterns. And as you say, that's because usually it's the large accounts that move these prices, same large accounts the whole time. They're buying, selling, buying, selling. And so two things, this notion of the language, absolutely right. And if you think of it as a language, it stops making it so bewildering, and it starts to give you a model that says, okay, I can learn this and I can get good at it. I can learn vocabulary, I can learn phrases. And then the point about, limit the number of things you trade, learn the personality of the securities you trade. It can really help you. It can help you win. It can help you avoid losses.
100%. And, it's kind of crucial to really get an idea of, so for example, you don't want to just jump into the market if you don't have really any understanding. It's kind of like going and just jumping into a Ferrari and not knowing how to drive stick shift, and it's just a recipe for disaster. So one, I mentioned you need to know your time frame, but you also need to know yourself. If you know that you're an emotional person and you'll get attached to trading, maybe day trading is better for you, because do you want to hold a position overnight and be worrying about it all night and then wake up and the first thing you think about is the market? That's probably not a healthy way of looking at the market. If you do get very emotional and you get tied to things, I have a personality kind of like that. You don't want to necessarily be putting yourself in a position where you're getting so emotional that you're thinking about a trade when you're not even, you don't want to be going to dinner with your family and thinking about a trade. That means that the trade, you're either too heavy or maybe you're just too emotionally connected. Maybe your bias is showing, but you really don't want to put yourself in a position where you're doing a trading style that doesn't fit your personality. I think trading does a great job at figuring out what type of personality do you have. Does day trading work? Do I like to wait and kind of wait for setups to evolve over days or weeks? And then once you can find and understand what style works for your personality, then you'll be a lot more comfortable and you'll be able to remove emotion a lot. One technical setup using charts that I really like to use is called an SR flip. It's something that's taught in the CMT as well. It's also a pretty basic technical term, and essentially it is a previous resistance level flips to support, or a previous support level flips to resistance. This is a great example on Chewy. This is actually a trade idea that I shared through my subscription on Twitter. And it was very simple. It was, you've got a breakout. So you had previous support here back in March. You then broke down through it. here. You then retested the top of that area here, and then you finally broke out through it. And a lot of people like to breakout trade, which is fine, but it's you get a lot better risk to reward when you wait for a pullback. So anytime that you see a breakout or a breakdown, you should always have a default assumption that you're going to retest that area that you broke out of. So in this case, the trade idea for Chewy was, all right, well, we recently broke out. We are now retesting this previous support zone that was acting as resistance multiple times. We broke out, now we're retesting it. We've got a nice hammer candle here. If you're not familiar with the anchored VWAP, the anchored VWAP is a tool that I use almost in every single one of my charts. And it's essentially the volume weighted average price, but from a specific point. That's where the anchor comes from. You're anchoring it from a specific point in time. Brian Shannon is essentially the godfather and really the main evangelist of the anchored VWAP. He's written a book on it. He taught me everything that he knows about it and how he's used it for trading. And this a lot of the time can be used with basic horizontal support and resistance zones. So notice here we have this SR flip zone that I talked about. The SR flip zone was right in line with the anchored VWAP. And for me, when I made the trade idea, I established an upside target. So the upside target, I don't have it on here, but the upside target was essentially this VWAP zone above. And let me remove this band here. This was my upside target. And then more importantly, was I had an invalidation zone. My invalidation point was a break below the bottom of this zone, but the anchored VWAP here was also crucial. So once the price started breaking down through the anchored VWAP, red flag number one. Red flag number two is we broke and just absolutely blasted through this $33 level here. I made it 33 because that's an even number, more of a psychological number than anything. But if you wanted some flexibility, 390 to 395 would have given you a little more flexibility. But regardless, we broke down and pretty much didn't stop dropping. Now, if you would have simply just waited till the last 15 minutes of the trading day and said, oh, wow, we're way below 33 right here at 31.62 at the bottom, then, that probably wouldn't have been the best kind of stop out. You do want to look at price action throughout the day. Even if you are looking at a daily candle, you want to look at kind of intraday and see, is there weakness, is there strength? And so, there was a very clear invalidation level. I mean, even if you did stop out here at 31.62 right at the end of the day, we still dropped all the way down to $30 2 days later. So if you had if you had short-term options and if you were still holding here, that short-term option after going down to about $30 is nowhere near what the same price as it was 2-3 days ago when we initially broke down. So you do have to definitely have some idea of what's going on intraday, even if you are using, let's say, a daily candle for your invalidation level in a break. This was an example, I think around 32.75, I posted to subscribers, hey, we're breaking down through that 33 invalidation level. The candle's not looking good. Technically the invalidation is a daily close, but start considering, the intraday price action here. And, kind of back to the SR flip, right? We broke down. We pulled right back up to that resistance zone, which now is resistance, anchored VWAP as well. And then we continued down today. Decent candle. I wouldn't call this a favorite looking hammer candle into tomorrow, but you can see quite a wick here. So, sticking to a plan, and even if you stopped out and price went back up, at least you're sticking to a rule. So, for next time, at least I'm making something that's systematic. I'm not just going off on a limb and saying, oh, we'll stop out based on how I feel at the end of the day. If I'm in a good mood, we'll stay in. If I'm not, that is not a strategy. coming up with a strategy and having invalidation and targets before you even enter the trade allows you to create a roadmap for yourself, so you're never going to be surprised at what happens. You know what's the upside, you know what the downside is, you know when the trade is no longer valid, and that's how you can just completely remove emotion and make it a very almost a robotic type of way at looking at the markets. And a lot of the time, if you do stop out of something, you will have a bounce. And then what you don't want to do is you don't want to just chase that bounce, right? Like for example, here, if you had the Anchored VWAP and you saw that we moved up yesterday, you may have gotten excited, but you would have known, okay, we're still below the Anchored VWAP. There's nothing here to really go off of for an upside trade. This is simply just testing where we broke down from, and then we're pulling back. A great example of this is XOM right now. So XOM was a trade idea that I put on this weekend as a new trade idea for subscribers. And this is exactly how you want to look at it, right? The idea was, all right, here's your SR flip, here's your previous support, acted as resistance. Here's your kind of breakout on Friday above it, and you did have a breakdown. Now, what was important was I told subscribers that this was a trade idea on the weekly chart. So you really want to, and I'll show you guys the weekly chart. And this is another thing. You want to know what is your thesis based on? Is it based on the weekly chart? Is it based on the monthly chart? Is it based on the 30-minute chart? So in this case for XOM, you did have a breakdown of that general area, but the trade was based on simply this hammer candle on the weekly chart. And let me just turn off this so you guys can see this a little better. So the invalidation would come on the weekly chart, not the daily chart. So even if the daily candle didn't look great, you still had to follow the basic rules of the idea that I provided. The original idea said, if we get a close on the weekly below 104.50, that's an invalidation. And you could have used the daily candle as an invalidation as well, breaking below the support zone. However, if you go back to the daily candle that we were just looking at, you never broke down through 104.50. So, technically you could have just stopped out because you got nervous, but if you were sticking to your rules and sticking to the plan, you would have seen that the low and the close of the day was right around 104.90. 104.50 was never broken down. And so if you were just sticking to the basics of the rules within the trade idea, this would not have been a trigger to get out. The idea's target above was simply the swing high anchored VWAP. We hit that today. This is more of an anchored VWAP zone. And now moving forward, I told people, hey, there's not much of an edge here until price can close back above this swing high anchored VWAP. So yes, we did move up again today, but you're trading below the anchored VWAP. So anytime you're trading below the anchored VWAP, that means that the average participant, since in this case this is your swing high, this is essentially your dollar cost average of everybody who's traded XOM since this high on April 28th. So as you're getting back up to this area, you're getting back to a price where the average participant is back to break even. If somebody just dealt with a drawdown all the way down to 102 and they entered, at 110, and then they get back to break even, or the average amount of shares are back to break even since this swing high, you're naturally going to hit resistance, because that's when people say, all right, well, I just dealt with a drawdown, I'm back to break even, I'm going to take some off the table, or maybe I'm going to take my whole position off the table. That adds extra supply onto the market, and that's essentially how you get resistance coming in. So the reason why I brought this up is now the new trade idea is when we can get a daily break and close above this swing high VWAP, that will then trigger the next move up to potentially test this gap above. As I mentioned earlier in the presentation, gaps are probably the best targets you can use in the market. Prices always gravitate towards gaps in the market. Not every gap fills in the market, but a lot of the time they do. And so for me, I told subscribers today, hey, this doesn't look bad, but it would look a lot better and you'd have a lot more of a risk to reward set up with a daily close above. Because then if price closes back below this anchored VWAP, that's your invalidation. Here, you don't have as good of an invalidation level. So, whether that is for you is maybe a moving average, whether that's a VWAP, that's where you as a trader need to figure out what, from my experience, works best. Is it anchored VWAP? Is it a moving average? Is it the RSI breaks back down below 30 is when I stop out? I would recommend definitely using things on the chart versus, just waiting for like an oscillator, like an RSI to get below X price, because that can, if the RSI doesn't close until below 30 until the price is 10% lower, then that's a 10% drawdown that you're having, or a 10% loss, when maybe you could have easily used a VWAP that had a much tighter risk to reward of maybe 2%. So I would definitely recommend things like VWAP, anchored VWAP specifically. If you haven't used the anchored VWAP before, definitely go on YouTube and just type in Brian Shannon anchored VWAP. You'll learn a ton. He's got a ton of free content out there. As I mentioned, he taught me pretty much everything I know about the anchored VWAP. And it's just a way to have targets, have invalidations. For example, here, and I know we're about to run out of time, MGNI is a great example of this as well. This was a trade idea that was mentioned over the last week. And the trade idea was actually something that was kind of being mapped out way before it actually became valid. So up here on May 15th, I noticed that price was starting to pull back after an earnings gap up. I mentioned, hey, we're getting, we're likely going to get a pullback down to this swing low anchored VWAP. We need a decent looking candle to form on the VWAP before this becomes a trade idea. And as long as the daily price does not close below the swing low VWAP, this trade idea becomes valid. What did we have on the 17th? We had a little bit of an intraday move down, but we did close above the anchored VWAP. The target on this was simply just a retest of this previous high. Within 3 days, we got that. We got a slight pullback, but price is still looking pretty good here. So I know we kind of went over a ton of things, and there's a lot of information to go over within this 40-minute time frame we have. But if you are really interested in not only maybe getting some different perspectives on the market, maybe some trade ideas that you may be able to turn into your own trades, that is what my subscription focuses on, is really educating people on the why. Any post that I'm doing in written analysis, I'm identifying what's the invalidation, what's the target, when does the next bull thesis target initiate, all of those types of things. And I'm strictly using charts. I'm not worried about the federal deficit. I'm not worried about what the Fed's doing. I'm strictly looking at price, and price is really what tells the story. And that's why it is really important to use charts to really remove the emotion that you can easily experience when you are trading.
Jake, that's fantastic. Thank you. Before we finish, if anyone has any questions, points to raise, anything at all, shout into the system. I've unmuted everyone our side, so all you need to do is unmute yourself and shout. There is a question function in the webinar system here. It's a bit steam powered, but it does work. So anyone has any points, do shout now. I've sent that. Jake, do you want to just explain to people how they can subscribe? Because I'm not sure many people are yet used to the Twitter subscription platform. So whether you show it on screen or you just talk through it, if people want to sign up, what do they do?
Sure. So I'm going to go on Twitter and go to somebody else's thing, because since it's my Twitter, it won't show up. I'll go to a friend of mine, Greg. So if you go to my profile, Greg's actually a pretty funny meme account to follow if just to get a laugh every now and then. But he has like a $1 subscription a month. But the reason why I went here is because you can see where to subscribe. If you just go to my profile, it's at Jake__Wojastic. Alex, if you may need to put that one in the chat.
Yeah, I'll circulate it. Yeah.
But if you go to my page, you just click on subscribe here, and it will take you to the subscription page, and then you just go down to the bottom and subscribe there. So it's pretty simple. One thing I would definitely recommend, and this is just because unfortunately Twitter definitely does still have some bugs on the subscription side, mostly around with Apple. If you can, definitely subscribe through your computer, because I've had probably about 15 people tell me that they subscribe through Apple and then Apple charged them, but then they for whatever reason didn't become a subscriber. So I can see on my end very quickly if somebody's a subscriber. I just go to their profile and it says they subscribe to you. And so definitely other people have signed up through Apple and it's worked fine. But if you do want to try to avoid any issues on that front, I would just sign up through your computer on twitter.com. It will definitely go through there. I haven't gotten any bugs that tell me that they've had an issue signing up through the computer. If you sign up through your mobile device on Apple through the Twitter app, there's just a slight chance that you are going to have that bug that other people have experienced. So yeah, you just go to my profile and click on the little pink subscribe button there, and just scroll down to the bottom once that little page pops up, and you can subscribe for $10 a month there.
And just to be clear, you subscribe on your computer, but it still works just fine on the phone app, right? Once you're signed up.
Yeah. Once you've signed up, and what I've told people is, and Apple's really good at this, if you do for whatever reason have an issue, just send me a Twitter DM and tell me, hey, I signed up through my phone, but for whatever reason it's not showing me your subscription tweets. Unfortunately, you'll just have to request a refund from Apple and then resubscribe through the website. But if you do sign up successfully through your phone and everything goes through, everything works great. I just want to be upfront that there is a weird little bug with some people who have signed up through Apple.
Jake, that's great. Look, I can say that this is a We Accesstrian Subscribe. It's a fantastic service that Jake runs. There is no religion or hyperbole or anything like that. There is just a series of setups, probabilities. This looks like a good idea. This looks like a good idea. This might work. This might work. There's no hectoring. There's no attempt to blind with science. It's just a really simple, very usable, great service. If anyone's interested, I would highly recommend you go and check it out. Jake, thanks so much for coming to talk to us today. We'll circulate this video once it's compiled in a couple of hours' time, and look forward to talking to you again in the future, and wish you all the best with the new service. I'm sure you're going to do fantastically well.
Thank you so much. Thank you for having me on. And if anybody has any follow-up questions that pop up, you can always send me a Twitter DM, and I'm happy to answer them.
That's great. Speak to you soon, Jake. Thanks a lot.
Thank you.
All right.